Year. It's the third year doing this luncheon, which we really enjoy. We spend a lot of time and effort putting together our outlook each year, and it's nice to show it to people. So we really appreciate the invitation. So I do want to introduce my Waterloo team here. I've got our CEO, John Chapmas, and our analysts, Randy and Logan. They do a lot of heavy lifting with our research every year. And so if anything doesn't turn out correctly in this forecast, that's their fault. So anything that's right, of course, is mine. So Waterloo Capital, we're one of the fastest growing RIAs in the country, based here in Austin, although we have offices in Dallas, Houston, Bentonville, Waco, College Station, and Atlanta. We've got 26 investment advisors across the firm with roughly $1.9 billion in assets and 7 underlying teams. And each year we do a lot of work at the beginning of the year to really try to identify our core themes that really guide our investments throughout the year. We spent a lot of time kind of starting at the beginning of December, going through and trying to understand what the market views on different areas of the economy, sectors are, and we try to compile this in an outlook each year. And for discussion today, we're going to review our outlook for this year. We'll review 2024, look at some of our core themes facing the markets and the economies this year, look at inflation, the Federal Reserve, interest rates, and finally touch on real estate. So last year, the title of our market outlook was Defying Gravity. And gravity in this effect is the effective interest rates on valuations throughout the market. In 2024, we witnessed the market really defy gravity in terms of higher inflation, higher interest rates, but the market still raced ahead. Now in 2025, we find ourselves really facing a moment where parts of the markets are either going to reach what we call gravity's edge, where they can lift off and go beyond the drag-on effects of interest rates, or crash back to earth. So let's go into last year. Making predictions is really hard. Last year, if we kind of look at the screen here, this is what a lot of the top Wall Street prognosticators said. It was prime time for bonds. The market was on shaky footing. The Fed was going to raise rates 7 times. But when we went through and did all the research, we were really concerned about inflation. We thought that the Fed going through their easing cycle was not going to be able to really kind of push through the amount of rate cuts that they were going to do. And as we finally look at the new year as investors, we want to ensure that we embrace the active nature of the markets and really be flexible in the face of changing conditions. And really, gravity's still here in terms of higher valuations, but on Wall Street, optimism typically reigns, and typically the reality is somewhere in between. So this year and for the foreseeable future, we really expect for lower and muted returns in the stock market that we've been used to in the past few years. But 2025 will offer opportunities for those who are able to adjust and change with the times. So let's look back at what we did last year, what we called for last year, and what actually happened. So a few things that we did get right were on the economy. We thought we'd be in slower growth, but avoid recession, which was mostly correct. Coming to the year, the market had priced in 7 rate cuts. We really thought that inflation would be more persistent, and the market had overpriced cuts for the year, which was absolutely correct. We said that we were stuck in a game of tug of war with the economy, in a situation where the Fed were going to have a really difficult issue putting in more accommodative steps with the amount of inflation that was really persistent. What we got wrong, while we certainly thought that the market was going to appreciate last year, we didn't price in a 25% gain on the S&P. We thought Magnificent 7 stocks, the 7 largest tech stocks in the market, couldn't possibly recreate the performance that they did in 2023. Those stocks were up collectively 48% for the year. And we thought it was finally a time for bonds to shine in portfolios with increased interest rates, increased yields, and the aggregate bond index was up 1%. So this is why projections are just that. You have to be nimble and adjust your portfolios in the face of changing market conditions. So let's look at the stock market from last year. The stock market really defied a lot of the expectations of higher interest rates and elevated valuations that would affect performance. The S&P was up 25%, making it the first back-to-back 20+% year since 1995 and 1996. And looking at the more growth areas, NASDAQ and growth equities were up over 30%, which were really banner years for those sectors. And it was also another year where domestic equities really outpaced foreign markets. We'll talk about that in a little bit later, but really for 7 of the last 10 years, we've had domestic equities outperform foreign equities. But if you go back to the 2000s timeframe, it was really reverse, where foreign markets have outpaced the US. We're going to talk about some of the reasons behind that. So going into the bond market, looking at bonds coming into the year, many call for yields to fall and bond prices to rise. Bond yields were touted by many on Wall Street to fall material last year with Fed cuts, but instead, persistently higher interest rates weighed on performance. While the bond market on the whole was only up 1%, the more equity-sensitive asset classes like high yield and convertibles had really solid years. Looking forward, we recall that bonds do have a place in portfolios, really as a method to reduce volatility, capture some income, but really it's predicated on interest rate movements. So in our outlook, we outline 4 themes each year, really to try to help us gauge the main issues affecting the market. And the first and most obvious issue this year is the election of Donald Trump and the policies that his administration are going to put in place. The Republican sweep in Washington really laid the groundwork for sweeping policy reforms. And on the back of the election, markets really surged following his election to promise to lower regulations, lower taxes, and put in pro-U.S. growth policies. And we're going to dive into those policies and see exactly how we think they're going to affect the market. So let's take a look at some of Trump's policies and potential impacts on the economy. But first, let's take a step and look at previous administrations and their effect on the stock market. We look back, going back to the 50s and the Eisenhower administration, the average returns for both Republican and Democratic presidents were really almost directly in line. The party doesn't matter as much as, and the policies that Trump and his administration want to put in place. The 2 first that we want to look at are taxes and deregulation. The first effect is going to be the Tax Cuts and Jobs Act. This was passed in 2017. It was the largest tax overhaul in over a decade, and it's set to expire at the end of the year. So let's look at the impact if it were to expire. The Brookings Institute estimate that the average American would see a 1.8% reduction in their income. Top 1% could see a 3% cut. And with these higher taxes, the government revenues are projected to increase by $4.6 trillion over the next decade, which is roughly equivalent to 1.6 of GDP. Given the government really having majority Republican-led, we really think it's highly likely that they're going to extend a lot of these cuts before the end of 2025. But there are tight margins within Congress, and the resistance to measures like the SALT cap and corporate tax rates remain. The effect of the extension would be felt in 2026, but any clarity that we're able to get before then would factor into consumer spending this year. The second effect is deregulation. Trump ran a pro-growth agenda promising deregulation across a lot of different industries. And the deregulatory policies that he put in his first term are expected to return, which would benefit banks, fintech, and startups, creating a more favorable business environment. And in this environment, we would expect that mergers and acquisitions, which had been really static over the last 4 years, we'd expect those to really rise this year. So let's take a look at the federal budget. One of the more unique policies that Trump has put in place is what is known as the Department of Government Efficiency, otherwise known as DOGE. It's Elon Musk's favorite word, and he, along with Vivek Ramaswamy, are going to be running that. While they have very little power from a regulatory perspective. It's really an advisory panel where they're tasked with going through and trying to find $2 trillion worth of federal cuts. While this certainly is an innovative idea, over 60% of federal spending are in untouchable programs like Medicare, Medicaid, Social Security, and defense. So finding $2 trillion from $7 trillion in our federal budget would be, create a lot of austerity. Past efforts to reduce federal spending has really had mixed results. And that really kind of highlights how difficult it is to cut federal spending. DOGE has ignited an important conversation around government spending and the inefficiencies and fiscal discipline. And if we really kind of look at how we are funding the national debt, there are really structural fiscal challenges facing our spending addiction. You can see for next year, we've got over $2 trillion in deficits that we're going to have to finance through Treasury instruments. And since COVID, there's really been a bipartisan reliance on debt-fueled spending, which continues to be a problem. And while we think it's very unlikely that DOGE or any of the policies or anything that they're recommending can really create any sort of meaningful changes, we think the conversation is important. So let's switch over to tariffs and immigration. The Trump administration policies present to really try to put sweeping 10% across the board tariffs across a lot of our trading partners. The effects of that could really make it difficult to strike a balance between the growth initiatives and a lot of the economic risk associated with them. With this America First agenda that he's talking about putting into place, we want to bring manufacturing back domestically, but basic economic principles tell us that whenever you increase tariffs, production costs rise, especially for U.S. manufacturers that use imported goods, which would likely trickle down to consumer prices. That overall net effect for 10% sweeping tariffs would be around 1% in GDP hit for the year. And considering, we've been at 2.6% GDP growth this year, that would really push us more towards a recessionary environment. But you have competing effects where, you have accommodative policies and then really sort of inflationary policies associated with that. Second, Trump's policies on immigration reform. On his first day in office, Trump signed an executive order declaring illegal immigration a national emergency, ending birthright citizenship and increasing funding for immigration enforcement. And if sweeping deportation is made, the labor market could face disruption as undocumented immigration really account for 4.8% of our labor force, according to Pew Research. Worker reduction could slow GDP, exacerbate inflationary pressures, and really help deepen fiscal deficits. And so the economic impact really depends heavily on the scale and specifics of the reforms, which really remain uncertain, but could reshape markets in the year ahead. Moving over to our second theme, one of the core themes that we have this year is continued dominance of the U.S. on the global economic stage and from a return perspective. Conventional wisdom for a lot of investment allocators is that having a globally diversified portfolio is with a strong allocation of foreign equities, reduces risk, increases the return over a long time. And over the last decade, that certainly has not been the case. The results have been really less than desirable, and U.S. markets have outpaced global markets in 8 of the last 10 years. So holding a meaningful allocation for foreign and emerging markets as a portfolio diversification agent, we call it a portfolio diversification agent, meaning that you've had substandard returns for a long time. In coming to the year, it's clear that foreign stocks offer a huge arbitrage from a multiple standpoint, but we think that's a value trap, as we think the U.S. is going to continue to outperform over the near term and foreseeable term, supported by strong structural economic advantages. So why is that? So looking at productivity, there are pretty clear reasons the U.S. has outperformed international economies. The first is our structure as a market and the innovative ecosystem that we have. 17 of the largest 20 companies are based in the U.S., many being innovative market-leading firms. These firms really excel at efficiency, profitability, and operational performance amplified by capitalization-weighted indices. The U.S. fosters innovation hubs like Silicon Valley, robust talent networks, supportive policies like the CHIPS Act and Inflation Reduction Act, and a pro-business culture. This unique ecosystem's really allowed us to dominate globally, unlike regions where stricter regulations and less capitalist economic environments really occur. So the second reason we want to look at is the global talent migration. The U.S. offers and attracts global talent due to our prestigious education, career opportunities, financial potential, and lower tax burdens. The inflow of these skilled workers create a virtuous cycle of innovation and productivity, reinforcing the U.S. market's competitiveness. And looking at 2025, we think it's clear that there are going to be additional economic headwinds for foreign markets. The U.S. first trade policies enacted by Trump with tariffs, include tariffs on China, which could weaken foreign companies' competitive positions and resulting in a stronger U.S. dollar, making imports more difficult as well. Additionally, geopolitical tensions, including trade wars and international conflicts, create a structural risk that hinder foreign markets' profitability and growth. So pointing to this chart here on the screen, the U.S. has been at the epicenter of the AI innovation, really creating a divergence between the U.S. and international markets, where we're seeing worker productivity accelerate, where in international markets you're seeing them decline. And the U.S. now has more data centers in the U.S. than all other major countries combined. And this AI-driven productivity, these gains are expected to fuel domestic growth for the clear and intermediate future, mainly due to a lot of the investment that's been put into a lot of these companies over the last few years. So looking to our third theme really is, we titled this Casting a Wider Net. A few large companies really have dominated the market performance over the last few years, mainly the Magnificent Seven stocks, large tech firms that have really driven a lot of the AI investment, really taking over half the share of the market performance over the preceding 2 years. In our last year's outlook, we thought that valuations were getting a little ahead, but earnings growth was going to be positive in a lot of these companies. But this year, they continue to move ahead with advancements in AI, continued robust earnings growth. But this year, we really think there's an opportunity for some of the other stocks within the economy and the markets to outperform. So if we can look at these charts here, last year, quarterly earnings and sales for Mag 7 stocks were up 23.5% compared to the rest of the market, up 9.3%. In the chart on the left, you could see how these stocks have really dominated the rest of the market performance. So if you had core allocations to these companies, you had a pretty dramatic outperformance. So where will these stocks go from here? Conditions in 2025 are still favorable for these Mag 7 stocks. However, we suggest taking a more active approach and trying to find some value in other parts of the economy that can benefit from a lot of the AI spending that these large companies have been putting into place. And earnings growth has really been accelerating across the broad market compared to the Mag 7 stocks where we're starting to see a tail off. So in the focus in 2025 isn't just about earnings growth, but it's the rate of change of that earnings growth, where we're seeing earnings growth across the smaller stocks in the S&P 500 begin to accelerate, and you see a deterioration in earnings growth among the Mag 7. So we prefer taking a more active approach, getting a more of a broad market exposure, as opposed to just having concentrated exposure in these large cap tech companies. So let's move ahead to the economy. As we look at the year coming, 2025 coming into the year, we touched on, at the beginning of our presentation, really how improbable it was that the Fed engineered a soft landing the way that they did, really kind of since implementing a lot of the more austerity measures and rate hiking cycle in 2020. And there are really a few reasons for this. First, fiscal policies played a huge impact in this, with a greater focus on directed and targeted expenditures through fiscal intervention into U.S. consumers, which really helped prop up consumer spending. But unlike in past interventions, that really kind of focus on stabilizing parts of the economy, like the banking crisis or the real estate crisis before that. a lot of these directed payments were directly to individuals, which really pushed up consumer spending, which allowed us to kind of move through a lot of the issues affecting the economy. However, government spending as a percentage of GDP has reached levels last year not seen since the World War II, which reflects an unprecedented scale of these measures and really kind of the unsustainability around them. So, the second impact that we're kind of seeing right now is the impact of the AI boom, the adoption of large language models. It's really kind of structurally altered the economy, transitioning AI from a novelty like ChatGPT was 2 years ago to something that actually has a really productivity driving force. And so whenever we look at where we were a year ago from a business cycle perspective, we were seeing slowing growth in a lot of different areas. We thought we were heading past peak and into a contractionary environment. And what happened was, with the amount of fiscal spending and the productivity gains that a lot of the AI improvements made, we were transported back in time to an expansionary phase, which is where we find ourselves today. A part of that has been sort of the unprecedented job gains that we've had, really kind of going back to since 2010 with the blip during the COVID cycle. We've had positive job gains for the past 48 months straight, which really has driven a lot of the consumer, in a lot of their spending this year. But the Fed hikes that were put into place really haven't slowed down consumer spending. Consumer spending accounts for 68% of GDP, and last year they expanded at 3.7%. Though we do expect it to fall to around 2% this year. The strength in spending is primarily driven by the top earners who contribute 40% of total consumption, have benefited from rising equity markets and increasing real estate prices. Housing balance sheets among these high-income group remain strong, supported by a lot of the job gains that we've seen really kind of across the economy. So, however, we do think that there's a rising income disparity issue that's going to be a factor over the next 1 to 5 years. Lower income households and younger consumers are struggling with the impacts of rising interest rates, which is currently leading to increased credit card and auto loan delinquencies. Lower income households also have not rebuilt their savings to their pre-pandemic levels. Corporate executives are starting to talk about softening consumer demand, particularly with patterns shifting as households shift to tighter budgets. So with rising interest rates and diminishing purchasing power, they're creating pressures that can slow a lot of the economic momentum that we've been seeing. But this weaker consumer spending really might hurt corporate revenues, leading firms to either cut or lay off workers, which kind of creates a virtuous cycle to where we're seeing that impact on the labor market, which could in turn impact consumer spending. But in conclusion, we do think that we'll have positive growth over the next year with no recession. However, we do expect GDP growth to be around 2% for the year. So let's look at inflation. So the economy's strong, the consumer is strong, but on the margin, both of those sectors have a lot less room for error. Inflation, if we look, it peaked out in 2022 at 9%, and we're well past that now at 2.9%, but we're still above the long-term Fed target inflation rate of 2%. If inflation does remain elevated, combined with the efforts on the new administration's policies that can be inflationary in a lot of instances, we think it's going to be really difficult for the Fed to be able to cut rates next year. They're proposing 2 to 4 interest rate cuts next year. We think it's unlikely they get even one done. So let's shift over to the Fed. We all know that inflation's been elevated, the labor market's been robust. And so both sides of the Fed's dual mandate has been in really good shape, but both are a little bit more in shaky footing. So if we look at our outlook last year, we thought the Fed was underestimating the stickiness of inflation, that they were being too dovish on a lot of their rate cut projections. Many called for 7 cuts throughout the year. We thought we were going to see maybe 3 to 5. There were actually 3 cuts. September, November, and December. And in December, Powell came out and said their estimates for GDP growth have been elevated and that the risk of inflation is actually increased. So we see this built into the market expectations. The market expects rates higher for longer. The Fed still has their longer-term target in their dot plot, potentially 1.5% lower than it is now, but it's really unlikely that they're going to get there anytime soon. So let's look at something that we pay a lot of attention to. There's a concept in economics called R star, or the neutral rate. It's the rate at which the Fed's interest rate neither creates accommodative growth or restricts growth. This rate is what the Fed tries to go through each quarter and really try to understand where their accommodative rates stand within where R star is today. We think the amount of fiscal policy, fiscal spending that's taken place really has increased R star to where a lot of the Fed rate hikes that they've done from 2022 to 2023 really are having less impact on the economy. We can see this in terms of financial conditions since the Fed rate hikes became. We see, despite that, we do have higher rates. We have almost as loose conditions as we had in 2022 before the rate hikes began. And a lot of that is the effect that R star is actually increased. So the Fed's effectiveness in going through and cutting rates is being hampered by this. So, we're in a period where inflation's still high, GDP growth is on sound footing, and we're still, spending a lot of money from a fiscal perspective, and Fed accommodation is still in place. So let's go through and look at where we're at from the Treasury market. And in the first quarter of 2025, the U.S. Treasury is expected to issue $823 billion in bonds alone. That's a 29% increase over 2013. So that's a ton of money that's having to go through and cycle through the U.S. Treasury auctions. Exacerbating this issue is that there's been a strong demand decline in recent years as foreign investors, particularly international countries, really lowered their demand for U.S. Treasuries. So as we go through this and watch the Fed auctions, we think this might be an impact for higher rates this year as well. That will lessen the impact of any sort of rate cuts that the Fed wants to put in place. So looking at the 10-year Treasury yield, the Treasury yield coming into the year is at 4.6%. And it's helpful to remember that while rates at these levels might seem very high today, this was the norm as recently as 2009. And the market and the economy have done very well and really accelerated even at these rates. We have a recency bias to say that just because rates have risen so far, so fast, that there must be some sort of anchor pulling those down. We don't think so. We think this is more of a new normal and a reset. And investors across markets really have to get, really used to this higher interest rate environment and adjust a lot of their outlooks around assets. All right, let's look at mortgage rates. So the 30-year mortgage really has kind of vacillated between 6 and 8% since 2023 after the Fed hikes went into place. Currently, they just stand over 7%, which is clearly higher than many thought it would be at the beginning of last year. And after his inauguration on Monday, President Trump came out and signed an executive order stating that the cost of living crisis was an issue and that there was an executive order to lower housing costs and expand housing supply. He claimed that mortgage rates could go to as low as 3%, which is more than double where they're at today. Really don't understand how that would occur. Yeah. However, we do expect interest rates on 30-year mortgages to be between 6 and 7% for the year. We're kind of range bound right now, and that's probably where they're going to stay. So let's shift over to real estate. So real estate across sectors have weathered a really tough few years. Over the 18 months beginning in 2022, the Fed initiated what we call the Great Tightening, increasing interest rates at the fastest rate since 1981. In addition to the impact of higher rates, we had COVID restrictions, and other shocks, related to higher inflation, surging construction costs. However, as we enter 2025, I feel like we're at a turning point. Commercial real estate fundamentals are in relatively good shape as we enter the new year. Even the office sector, which has been a big detractor over the last few years, is starting to see some signs of increasing leasing rates. And so real estate's weathered a lot of these challenges, really kind of hammers home the point that real estate is a core part of the economy. We stabilize and it will be smooth sailing from here. We know that's pretty unlikely. And the changing policies in the Trump administration that I previously alluded to, really will affect the way that people work, and continued migration trends could impact the asset class in 2025. But let's focus on a few of them. So we think property values really across most commercial real estate sectors have bottomed. Over the last 3 years, valuations have declined really across all sectors, 200 to 400 basis points. Multifamily and industrial property coming into the year at a little over 5% on a cap rate basis. And office and retail, which were hit harder by the valuation shifts, just over 6.5%. So looking forward to the positive side, though we think that interest rates are going to remain higher than they've been, even with increased borrowing costs, the effect of the cap rate and the valuation perspective, we're seeing 2 to 3% higher levered returns on a lot of prospective commercial real estate projects, moving forward into this year. At the onset of the pandemic, construction was essentially halted. As the economy recovered much quicker than expected, there was a rush to build out a lot of multifamily and industrial properties. Predictably, vacancies really plummeted during that time period. Annual rent growth surged to a peak of 10% early in 2022. And developers were quickly able to capitalize on that tight market, breaking ground on a record number of new properties in 2021 and 22. And we've seen these new deliveries hit the markets over the last 2 years. However, this trend took a really large reversal in 2025. We expect new project deliveries to be down about 50% in 2025, primarily due to developers' inability to get any deals done in 2023 and 2024. And while certain sectors, namely multifamily housing, deal with these new properties that are hitting the market, this should lead to an attractive supply and demand dynamic in 2026 when a lot of the properties that are breaking ground today kind of come to the market. So let's look at multifamily apartment absorption. So 2023 saw a record amount of new multifamily properties hit the market, which saturated most of the top tier markets. However, rents have been mostly flat over this time frame as the markets really have adjusted and absorbed a lot of these properties. And we saw most of the absorption actually occur in the Sunbelt region, where a lot of the migration has been. And this is really kind of predicated on, a lot of the migration trends that we've seen since COVID. So there was a huge shift in how people work and where they want to live during COVID. And we've seen a lot of that outbound migration from either the West Coast or the Northeast down to the more of the Sunbelt region. However, that's starting to change. On average, we're really seeing, a lot of the trends that were kind of developed during COVID begin to reverse a little bit. Now that we're a few years past the pandemic, we're seeing some of the migration patterns shift, like cities like Orlando, Tampa, and even Austin are seeing much more moderate in-migration as these policies begin to shift. So, over the last few years, we had very, very strong in-migration of, up to 10% growth per year. 2024, it was roughly up 0.1%. We're starting to see other markets that have much more of a favorable business climate, but more suburban type areas really benefit. So, areas in a lot of these markets that we're seeing, like Minneapolis, San Bernardino, Sacramento, we're actually seeing a fair amount of growth there. So that's going to impact how a lot of new capital is deployed in the market over the next year. Another issue facing really single-family housing, but specifically benefiting multifamily, is the continued housing unaffordability. On average, home prices nationally are 50% higher than they were prior to the pandemic. And looking at interest rates are really kind of pushing through and creating an environment where the cost of housing is just out of reach for a lot of individuals. Ironically, the Fed's attempt to cool a lot of the inflation that we saw going into 2022 actually caused the housing market to essentially lock up, and there was no homes sold during those time periods. But the combined effect of all these issues has really caused home affordability to fall to really an all-time low. Another issue affecting the market is this credit cliff that we're seeing. I talked about this last year, but kind of looking into 2024, the market faces roughly $928 billion of real estate credits that will be maturing. And of that total, 20% of those are actually underwater, meaning the value of the real estate's actually below their outstanding debt. And so this is an issue that the market's going to have to deal with over the next few years. Banks have been really slow to address this issue. They've letting investors really extend and pretend that conditions are going to change. And so this year, we're expecting $500 billion in loans to mature. And of those loans, we think a large proportion of them are going to be underwater as well. Primarily in office, where we're going to see roughly 30% of those loans mature underwater. While we do expect higher valuations in the real estate sector this year, we do expect increasing distressed properties to come up to market, or more bank-owned properties to have to be put on balance sheets. So to kind of step into new issuance on the origination, Paul Getty said once, if you owe the bank $1 million, you have a problem. If you owe the bank $100 million, the bank has a problem. Banks have a problem today, and they're going to have to work through roughly $750 billion in unrealized losses on their balance sheet, mainly related to a lot of the office projects. And a lot of these projects are going to come back to the debt markets this year. And we're seeing a lot of the well-publicized lenders like private equity, pension funds kind of step in and fill the gap that banks have left. But we're seeing CMBS issuance really pick up. We saw CMBS issuance up 37% last year, which is a positive sign. And moving forward, banks are going to have to work through a lot of these bad debt on their balance sheets. However, our expectation is that the CMBS market will fill this gap as transactions activity improves, prices bottom out, and we do expect credit standards to remain fairly tight. So let's go through our projections on the multifamily space. We think that record high housing costs keeps multifamily assets in favor. Secondly, we think a record number of new apartments opened in 2024, pushing vacancies up by 0.5%, despite the strong demand. However, the national vacancy rate was probably hit its peak last year at 6.9%. But moving forward, we expect a lot of those to be absorbed as new properties coming to market lessens. New supply is quickly diminishing. Construction activities fallen 40% from its peak, with new starts at its lowest level since 2012. So if you're able to get deals done this year, you'll be essentially opening the property into a market where there's a lot less competition. So looking into office, we think Class A trophy assets really offer the best pricing opportunity, one of the best investment opportunities in the market today. These assets are being priced at cap rates alongside sort of their office counterparts, really along the lines of industrial and multifamily assets, which have a much lower cap rate, but very similar tenant profiles. So we think that sector should do fairly well. In the aggregate, though, the office sector is still distressed. Vacancies hovering around 19%, which is a high. However, there's virtually no new supply coming to the market. And as these premier assets fill up, we do think vacancies will fall as new business development really occurs, or that kind of need to take down this space. So we think we've hit a bottom there. A lot of the stress assets we probably won't see a bottoming until early in 2026 as some of these more distressed properties kind of work through the banking system. On the positive side, there are signs that corporate America's fixation on work from home is beginning to shift. 83% of CEOs said they expect a full return from work within 3 years, and that's a comparison to 64% last year. Additionally, we're seeing a lot of the tech companies that typically have had more generous work from home and more back to work policies. So we think we're going to be seeing more of a traditional working environment like we had before COVID sometime soon. So shifting to our overall takeaways from our presentation, in 2025, fiscal policy and AI spending is likely to keep the economy moving ahead, although we think it's going to be at a slower pace. Inflation will remain pretty sticky, and we don't count on Fed cuts this year. We expect a broadening of public equity returns outside of Mag 7. We think that U.S. remains a growth driver globally, as there are going to be a lot of headwinds for global economies. And in 2025, we think we're going to usher in a new cycle in the real estate market in a lot of different sectors. That's it. All right, we can open up for some Q&A if anybody has any questions. This year, sort of tactical things we're looking at. Data centers are really interesting. We're starting to look into that space. We're looking into software VC, where improving AI, kind of going through and creating operational efficiencies. That's kind of something we've been looking at. But really kind of sticking to our knitting of just being active investors, really trying to find opportunities within U.S. equities. We've got our team that are scouring the market every day. We've got our proprietary models that we're using to evaluate a lot of the momentum in the market. That's kind of where we're looking at this year. But we've got a process, and really it's a client by client perspective where we're trying to sit down and really understand what's appropriate for them.
Just drill, baby, drill.
We're really positive on U.S. energy right now. We've had a fair amount of exposure in E&P over the last few years. Sometimes to our detriment, especially with oil prices kind of dipping in from 2017 on. But we do think there will be reduced regulation around that. We think it's going to be a really positive environment for U.S. drillers to kind of work here domestically in the different shale formations. And so we definitely have some exposure there. We'll probably be increasing that.
Any ideas on are y'all investing in like power consumption, power up all this AI and Bitcoin mining and all these different things?
Yeah, I think the energy infrastructure is really interesting. And those are sort of longer term plays that really kind of have an inflation hedged piece to that. As we kind of look at that space, we think data centers really are really, really attractive right now. Those are areas that we're going to need a lot more of them if we're going to expand out a lot of the AI-driven technologies that are currently talked about and trying to be implemented across a lot of companies today. That's an area that I think will do really, really well over the next few years. But energy infrastructure, outside of oil and gas, should be pretty stable. All right. Well, thank you very much.